Hi everyone, I'm Sherry Clarke with Clarke Financials and I provide expert bookkeeping for small service businesses. And today I want to give you guys 3 things that every business owner gets wrong when it comes to their balance sheet and really how important a balance sheet is. First things first, what is a balance sheet? A balance sheet is where you list all of your assets, your liabilities, and your owner's equities. So income statement, it's what most business owners focus on, right? Is their income and their expenses. That's their P&L or their income statement. That's the same thing. The balance sheet is where you actually list your assets, liabilities, and owner's equities. So it's what you own, what you owe, and how much money you are putting into the business or taking out. So really, if you were to sell your business, what could you get out of it? Your assets, so whether you own the building, whether you own all your inventory, depending on what type of business you have. And then minus your liabilities, which is going to be any loans or anything you have to repay, like your credit cards, things like that. The top thing that I would say I see from owners when it comes to their balance sheet is not understanding the difference between personal and business expenses. So I actually had a client that wanted me to look at their balance sheet and their income statement and just tell them what I thought. And that was kind of the top thing that I saw. Their mortgage payment was actually on their balance sheet. And they were listing it as this something that the business owned was their mortgage to their house. And then they would pay the bank directly from the business account, which is a no-no. So what the owner actually needs to do is take an owner's draw and then pay their mortgage separately. It's not owned by the business. If he were to sell his business, he's not also selling his house. He can't sell the mortgage on his house with the business because it's not under the business name. It's not being used for business, which would be different than the home office expense. Don't put any assets or liabilities that are purely personal, like your personal credit cards, personal assets like your house, your car. If it's not under the business name, it cannot be listed under the business assets. The second thing I would say that I see from business owners is not really understanding what owner's draws are. So a lot of business owners, I would say, think that owner's draw is the same thing as an expense or paying themselves. So I actually had a client who was trying to do this where they were like, oh, that's my pay to myself, where I'm just taking out money and putting it into my personal account. It's not actually running through a payroll system where it's taking out the taxes for their payroll. And I said, that actually technically is not a payroll. That is an owner's draw. And that is purely balance sheet related. That is not an expense to your business. I want every business owner to know that. When you take out an owner's draw, which is perfectly legal, you as a business owner can take out money from your business anytime you need it, as long as it's there. You can just transfer from your business bank account to your personal bank account. Totally okay. But that is not an expense to the business. That's not a tax write-off. You have to run it through a payroll system, which they're taking taxes out just like you would an employee, especially if you're an S Corp, which I'll get to in another video. The difference between an LLC and an S Corp, which is some of my favorite topics to talk about. But if it's not running through a payroll system, it's not a business expense. It's not the employee side. You actually have to be taking taxes out in order for it to be a business expense, which there's a double-sided how much you really should be paying yourself if you're an S Corp. So don't just jump in and start paying yourself a bunch of money so that you can have it as a tax write-off, because it might not benefit you totally in the future.
As a business owner takes out draws and transfers it to their personal account, which is perfectly fine. Once again, that isn't a business expense, so keep that in mind. It's not the same thing as payroll. Last thing I will touch on is I had a client who renovated a building that they didn't own. They were renting out a suite in the building, renovated it, added a bunch of office space and everything. And they actually put that on their balance sheet, which also is not a thing. The owner may give discount or maybe a certain amount of credit towards their rent, but they don't actually own that building. If they were to sell their business, they can't also buy that office space that is owned by somebody else. It's not owned by the business, not owned by even the owner. So that can't go on your balance sheet. That would be an expense. It's not an asset that can be sold with the business. So these are just a few things to think about and look at when you're looking through your balance sheet and your income statement and separating what is my expenses and my revenue and what is actually an asset, a liability, or owner's equity that I'm taking in and out. Just some thoughts, and follow me for some more tips. I got a lot more to come, a lot more to talk about. I'm super excited. Thanks so much for your support.